Okay, we're going to wrap up our examples from Chapter 3 with Exercise 8. This is the same information that we had in Exercise 4 and 6, but it's now using the cost method. So again, you'll notice that the basic information here from date of acquisition in terms of the percentage acquired and the DDE are exactly the same. Nothing has changed there because the underlying facts are identical. You'll also notice the amortization schedule now is exactly the same as it was in the prior ones because we're still doing it over a 10-year life. Hopefully what you've noticed is that there's an additional little box here. Under the cost method, remember that the parent never adjusts the investment account after that initial purchase. So originally the parent recorded the investment at the $272 or the price paid, and if we come down to the worksheet, we see that's the investment. Nothing has been adjusted. So the things that happened during 2011 and 2012 on the subsidiary side in their retained earnings have not been picked up by the parent. Well, to do that under the cost method, what we do is a catch-up entry or equivalent of a catch-up entry called the CV entry instead of our CY1 entry. And what we do is we try to basically bring that investment account up to the point in time that it would have been at the beginning of the year by looking at the items in this little box. So the subsidiary retained earnings at the point in time that we are doing the consolidation comes from the worksheet. So we're going to put that in there. We compare that to the retained earnings that the subsidiary had at date of acquisition, and we see that there is a $20,000 difference. And that's what would have adjusted the investment account. We have been doing one of the equity methods. So we're going to take that and adjust it again for our ownership percentage, and that becomes our adjustment amount. So you'll see that if we go down here to our CV entry now, there's our $16,000, and we record it to the investment account to catch it up, and we adjust the retained earnings of the parent. That's the only difference here, because you'll notice when we go to CY2, we still have the $8,000 of dividends. We're just taking it out of dividend income now on the sub because they don't record it as subsidiary income, they record it as dividend income. Otherwise, the rest of the entries there, EL, D, and A, should look identical. So we book the CV entry to the investment account and subsidiary retained earnings. We adjust for the dividends that the sub paid, just like we did before. $2,000 still falls over to the NCI, and then we do the same math. You'll notice the same allocation of income, same basic principles here. Okay, so hopefully between problem 1 and these 3 exercises now you see that impact. So what happens on the parent's investment account is accounted for by either the cost, simple, or sophisticated equity, and whichever of those methods are used then requires some slight modifications as we've seen in these 3 exercises on the worksheet itself, but the final product, the final consolidated balance sheet, is identical. So it does not affect the ending numbers, and that's the key takeaway here.